Would you like to own a slice of one of the highest quality businesses in the world? Want to profit from the manufacturing process of, well, just about anything? Like the idea of collecting a market-beating dividend that's growing at a double-digit rate? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. Also, make sure to stay tuned to the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is producing and supplying industrial gases. Hydrogen and helium. You want to know what they smell like? Money. You betcha. This company makes money hand over fist because industrial gases are part of the manufacturing process for just about anything you could think of. If you manufacture, you generally need industrial gases, and that need translates to higher profits and dividends for this stock. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Air Products and Chemicals Inc., which appear to be trading at a significant discount today. Air Products and Chemicals Inc., stock ticker APD, is a major global producer and supplier of industrial gases. They're the largest supplier of hydrogen and helium in the world. Founded in 1940, Air Products and Chemicals is now a $56 billion by market cap industrial gases behemoth that employs approximately 19,000 people. The company's fiscal year 2019 sales were reported through 4 industrial gases business segments organized by geography. Americas 43%, Asia 30%, EMEA 23%, and global 3%. Corporate and other accounted for the remaining 1%. The company serves more than 170,000 customers across more than 30 industries. This is one of those names that flies under the radar, but make no mistake about it, it's a very high quality business by nearly every measure, and the necessity of its products and services position it incredibly well for the future. Industrial gases are critical to a number of industrial processes. It's simple. Many end products cannot be manufactured without industrial gases as input. These gases are vital to operations ranging from food processing to energy product refining. Best of all, Air Products and Chemicals is part of a global oligopoly. There are only 3 major industrial gas suppliers in the world, which helps to ensure rational pricing. This all adds up to a very rosy picture with growing profit and dividends almost certain to persist for years to come. As it stands, the company has increased its dividend for 39 consecutive years. That easily makes it a dividend aristocrat. The 10-year dividend growth rate is 10.4%. They've been remarkably consistent about this. The company hands out 10% dividend increases like clockwork. Their most recent dividend increase came in at just under 12%. That dividend growth comes on top of the stock's current yield of 2.4%. This yield, by the way, is higher than both the broader market's yield and the stock's own 5-year average yield of 2.3%. The payout ratio of 70.4% is elevated, but that easily covers the dividend. I view a yield of between 2.5% and 3.5% paired with a high single-digit dividend growth rate to be the sweet spot for dividend growth investors. The yield is just below the lower end of that range, but the dividend growth is stellar. Looking at business growth, Air Products and Chemicals has seen its revenue shrink slightly from $10.082 billion in fiscal year 2011 to $8.856 billion in fiscal year 2020. A shrinkage in revenue is not something any investor likes to see. However, this drop can largely be attributed to the fact that Air Products and Chemicals purposely decided to make the business smaller and more focused. Their 5-point plan involved focusing on industrial gases and taking action on non-core businesses. The execution of this plan led to spinning off its electronics materials material division in 2016, as well as selling the performance materials division in 2017 for $3.8 billion in cash. In the meantime, earnings per share advanced nicely over the past decade. Earnings per share is up from $5.63 to $8.49, which is a compound annual growth rate of 4.67%. A substantial expansion in margins related to the aforementioned focusing definitely helped to propel bottom line growth in the face of revenue shrinkage. I will say that the company's GAAP earnings per share can be lumpy. Their growth can look mediocre or truly outstanding, depending on what time frame you're looking at. But I appreciate that the dividend growth is anything but lumpy. Either way, I think the compound annual growth rate in earnings per share belies the true growth potential of the business. Looking forward, CFRA is forecasting that Air Products and Chemicals will compound its earnings per share at an annual rate of 12% over the next 3 years. They cite volume growth in 2021 as we move past the pandemic, winning agreements in large industrial gas projects, and a large backlog as key growth drivers over the near term. And with gasification related to carbon capture and hydrogen mobility, the company has some very interesting long-term tailwinds working in its favor. Notably, the company benefits from the very nature of the business model. They work in sync with customers to build out large facilities that come attached with long-term contracts. These contracts are often more than a decade in length, which gives a lot of cash flow visibility. This is why there's so much consistency with the dividend raises. The company has a lot of confidence in future cash flow. I think CFRA's projection, which assumes a lot of earnings per share growth acceleration, is reasonable, as I simply view the last 10 years as more of an aberration than an accurate picture of the company's growth profile. And this kind of earnings per share growth would lay the groundwork for similar dividend growth. In turn, we're looking at a continuation of the status quo, and that's a lot to like when paired with the yield. Moving over to the balance sheet, the company maintains an excellent financial position. The long-term debt-to-equity ratio is 0.61. The interest coverage ratio is slightly under 20. Furthermore, they have a healthy amount of cash. Seeing as how this is a capital-intensive business model, the balance sheet is very impressive. Profitability is quite robust. Over the last 5 years, the firm has averaged annual net margin of 19.35% and annual return on equity of 18.08%. I view this as an ultra high quality company with one of the surest dividends you'll find. And with global scale, barriers to entry, high switching costs, a global oligopoly, and lengthy contracts, the company does benefit from competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Competition is limited in this particular field, but the competition that does exist is formidable. Demand for industrial gases is cyclical. Any reduction in economic output affects the company. The pandemic, for instance, shaved upward of 20 cents from the company's fourth quarter fiscal year 2020 earnings per share. The company is heavily exposed to major energy projects around the world. Major changes in the global energy complex could diminish the company's long-term growth story. Overall, I think this stock should make for an excellent long-term investment. And after the stock's 23% off of its 52-week high, I think the valuation makes the stock look extra compelling. The price-to-earnings ratio on the stock is 29.79. If we look at that in a vacuum, it's high. However, the pandemic has weighed on recent results. With the acceleration in growth that CFRA is forecasting, this PE ratio could quickly compress and make the stock look cheap in hindsight. I can also point to cash flow. The price-to-cash flow ratio is 16.7 right now. That's lower than the stock's own 3-year average price-to-cash flow ratio of 17.6, and the yield, as noted earlier, is higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is at the very high end of what I ordinarily allow for, but this company's consistency is almost legendary at this point. The odds of continued dividend growth in the high single-digit range at the very least are very high. It's surefire. There's nothing to indicate that the dividend won't continue growing the way it has been for decades. The dividend discount model analysis gives me a fair value of $324. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates APD as a 3-star stock with a fair value estimate of $305. CFRA rates APD as a 5-star strong buy with a 12-month target price of $320. We have a fairly tight consensus here. Averaging the three numbers out gives us a final valuation of $316.33, which would indicate the stock is possibly 25% undervalued. Here's the bottom line, guys. Air Products and Chemicals Inc. is an ultra high quality company that is positioned to take advantage of both short-term growth catalysts and secular growth tailwinds. With a market-beating dividend, almost 40 consecutive years of dividend raises, a well-covered dividend, consistent double-digit dividend growth, and the potential that shares are 25% undervalued, this stock should be carefully considered by every dividend growth investor. And for a special news announcement, I want to alert you about Bank of New York Mellon Corp, stock ticker BK. We did a video on the stock back in December when it was around $40 a share. It's bumped up a couple dollars per share, but the exciting news is that this bank announced it will start buying back stock again in the first quarter. That's right now. This stock could be a train just starting to leave the station. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.